I want to turn to our next guest, who's Doug Elliott, the Brookings Institution. As you know, Doug, we've been talking quite a lot about the issues coming up over the past weekend. In fact, Bernanke's confirmation vote, also Paul Volcker and his increased clout in the White House. But overall, this new regulation on the banks, or sort of this increased pressure on the banks, I mean, you say overall this is not going to be a good thing, right?
I'm concerned about it, particularly the proprietary investment restrictions, because we don't know what that means. Banks have a lot of investments that we want them to be making that the administration probably doesn't mean as proprietary investments, but there's no clear line. And we could easily have the details come out in a way that hurts business.
Now you've got Paul Volcker, though, the former Fed chairman, a guy with a lot of credibility, both among Democrats and Republicans here, pushing this idea, saying even if prop trading didn't cause the crisis, it's going to, if you limit it in some way, it's going to reduce risk overall. You don't buy that?
Paul Volcker is a great man. He's a hero of mine. But I think in this instance, he's pushing hard against something that's not a serious problem. We need to control the risk of investments, but we don't need to say anything that could be called a proprietary investment should be stopped.
You're saying proprietary trading is not a serious problem, then?
The investments that banks make haven't been the big problem here. They've lost their money the traditional way. They've made bad loans, or they've bought bad securities for long-term investments.
They've taken too much risk, for instance, on these, yeah.
Exactly. So we want to control the risk they take, but having a blanket ban on investment within certain categories, I don't think makes sense.
What about, though, the fact that it seems as if, though, that there is a general agreement that this does help address that too big to fail problem?
I don't think it's going to do much about too big to fail. They're going to put some sort of cap, completely undefined at this point, but they're clearly going to leave the biggest institutions in place. Well, we discovered we had to rescue Lehman and Bear Stearns, which were much smaller than this cap is going to be. So I don't think this is going to do much about too big to fail.
What about the bank tax that the president is also calling these big banks to pay as well? A lot of people are saying that's going to be a much easier political sell here on the Hill.
Well, the bank tax I actually support. I think it makes sense that the banks pay for the cost of the TARP, not the taxpayers, and it's an amount they can handle. We're talking about $90 billion probably spread over 10 years. They can easily handle that.
Doug, no matter what you might think about Volcker, I know that you just said that you actually do admire him. I mean, having a Volcker, a stronger Volcker voice in the White House, how does that change the economic landscape here?
It's definitely going to change the financial regulatory reform landscape, because Paul Volcker has strong views about the size limits. He has strong views about Glass-Steagall, about proprietary investments. Unfortunately, I think the views are somewhat outdated, but he does have strong views, and it will push towards a more populist view.
Okay, Doug, thanks so much for joining us and for stopping by here on the Hill. That was Doug Elliott of the Brookings Institution.